Short exercise 3-8. We're doing the adjusting entry for depreciation. So on May 1st, Chicago Gold Exchange paid cash of $28,800 for computers that are expected to remain useful for 4 years. At the end of the 4 years, the value of the computers is expected to be zero. So our first requirement is to calculate the amount of depreciation for the month of May. So we're not doing it for the full year, just for the month. So down here, they're telling us, begin by selecting the labels, then enter the amounts and compute the amount of depreciation. So what they're doing here is they're having us write out the formula for depreciation, for straight line depreciation, before we do the actual number crunching. Abbreviations used. This means accumulated depreciation, and we're going to enter a 0 for any zero balances. So the formula, if you recall, for straight line depreciation is you're going to take the cost of the asset, you're going to subtract the residual value, which is just an estimate of how much the item could be sold for, if any, when we are done using it, and then the useful life. So the useful life is how long do we think this asset will be useful for the business? In this case, 4 years. And then we divide by 12 months, which would give us 1 month of straight line depreciation. Now we're going to plug in the numbers. The cost was $28,800. The residual value is expected to be 0. So they think at the end of the 4 years, the computers won't be worth anything. And they think that the computers will be useful for 4 years, according to this. And then we're going to divide by 12 months to get the monthly amount. So we're going to take 28,800 divided by 4. Gives us $7,200 of depreciation per year. So each of those 4 years will have $7,200 of depreciation. But we need to record it only for a month at this time. So we divide by 12 months, which gives us $600 of depreciation for the month of May. So what this depreciation is trying to estimate is how much value has been lost of these computers as they get older. And that's approximately $600 a month. Next, we're going to record the adjusting entry for depreciation. So we have to record depreciation expense. So let's look at the 3 types of accounts that are being involved whenever we're recording depreciation. First of all, we have the asset account. In this case, the computer equipment. And like all assets, it increases on the debit side. We now have a new type of account called a contra asset account. Contra meaning it's lowering or offsetting of the asset's value. So because this accumulated depreciation account is a contra asset account, what that means is the value of this accumulated depreciation is really offsetting or lowering the value of the computer equipment, which is the asset. And then we also have depreciation expense. So whenever this adjustment has to be recorded that is showing that our computer equipment is slowly losing its value, we have to increase depreciation expense. And like all expenses, depreciation expense increases on the debit side. So we're going to record depreciation expense and debit it for the $600. So depreciation expense is increasing for $600. Let's get back to our T accounts. Now, what a lot of students assume is then to show that the computer equipment is losing its value, we're going to lower it directly. Well, we can't do that because the cost principle says we have to keep the original cost of the computer equipment inside the computer equipment account. So what we're going to do instead is we're going to use the offsetting contra asset account called accumulated depreciation. And as accumulated depreciation accumulates, in other words, it gets bigger over time, we have to put it on the credit side. Why is it on the credit side? Well, because this is a contra asset, it means its pluses and minuses are the opposite of the asset account. So as this accumulated depreciation grows, we need to credit it. So we're going to credit accumulated depreciation on the computer equipment, $600. To record depreciation on the computer equipment. Requirement 3, we're going to post the journal entry of May 1 and the depreciation of May 31st to the T accounts. And we're going to use the dates as the posting references to post the transactions. And then we're going to calculate the balance. So the May 1st transaction, if you remember, was them purchasing the computer equipment. So they purchased the computer equipment on May 1st for $28,000, $28,800. So because the computer equipment is increasing, we have to put it on the plus side, which is the debit side, since it's an asset. All right, now we're going to post this journal entry. So remember, when we post, we just take one line at a time. So we're going to post this $600 debit to depreciation expense. So here's the debit. And notice that the transaction, this journal entry to record depreciation, was done at the end of the month. So we have to use May 31st. And then we're going to post the accumulated depreciation $600 credit as of May 31st. And then they want us to do the balances, which is pretty simple. No math involved in this one. So we have a $600 credit balance and accumulated depreciation. And we have a $600 debit balance for depreciation expense. Now finally, what they want us to do is calculate the book value of the plant assets. Now remember, this computer equipment is a plant asset, meaning it's going to be lasting more than a year. So the book value of a plant asset, all we're trying to calculate is, well, what is the value of the computer on our books? And by books, I mean our accounting records. Remember, accounting used to be done in actual books. So the book value of the computer equipment is going to be the cost of the computer equipment, $28,800. And then we're going to subtract the accumulated depreciation, which is $600. So less means to subtract the accumulated depreciation, $600. And the difference, $28,800 minus $600, gives us $28,200 of book value. So what this means is that the computer equipment, after 1 month of use, is no longer really worth $28,800. It's approximately worth $28,200. Now, does this mean you could sell it for exactly that? No, that's not what the depreciation concept is trying to do. The depreciation concept is trying to take the value of this computer equipment and slowly lower it and turn it into an expense called depreciation expense over time as we slowly use up the value of that computer equipment. And that's it.